Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Now, it's been a geopolitically busy week with ongoing tensions in the Middle East, particularly with the alleged exchange of missiles between Iran and Israel. And that, of course, has been triggering some risk of sentiment in markets. Now, it wasn't just geopolitics. We had renewed concerns about US inflation, and that, started to push back market expectations over the timing and magnitude of Fed rate cuts this year. Of course, that meant some of the traditional safe havens like gold were winners out of the week's events. Now, what does all these events and the market reaction tell us about the potential path here for major asset classes, and how should investors respond? To discuss this and more, we have with us today Raymond Cheng, who's our Chief Investment Officer for North Asia. So, hi Raymond, thanks so much for joining us today. In your view, I guess, how should investors see recent developments from the perspective of their investment portfolios? I guess a couple of questions really jump out are on bonds, particularly, is the 10-year set to retest 5%, and should investors be chasing oil and gold higher?
Thanks for having me, Manpreet. Indeed, global equities have weakened over 3% over the week in response to the Israel-Iran tensions and the stronger U.S. economic prints. Now, in the near term, there's room for more volatility ahead, given the flare-up in the Middle East, coupled with the possibility that the market continue to reassess Fed rate hikes. Now, our board view is that any notable pullback in equities historically could become long-term buying opportunities for investors unless a recession is expected. Now, also, the Q1 U.S. earnings season so far suggests a better-than-expected improvement in corporate earnings from a year ago, which should alleviate recession fears to a certain degree. Now, as long-term investors, we should always stay disciplined and diversify across asset classes and geographies. The notable market drawdowns provide a golden opportunity to average into a diversified foundation portfolio and then add on opportunistic ideas around the core to exploit market dislocations. The hawkish comments from Fed Chair Powell did dial up U.S. government bond yields to levels above 4.5% throughout the week. Now, in the short term, the yield may have more risk to the upside as investors continue to reset expectations of the timing and magnitude of the Fed's rate cuts. Now, while persistent U.S. inflation pressures and concerns about energy supply chain disruptions could add upside risk, we do note that escalating geopolitical tensions and risk-averse sentiments pose downward pressure to long-term yields. Net-net, we think the direction of monetary policy remains biased towards looking for an opportunity to cut rather than to hike. Now, we don't see the level of inflation warrants a complete reversal of monetary policy expectations. Hence, we maintain our view that higher yields present an opportunity to add exposure to developed market investment-grade government bonds, which offer a favorable risk-return reward profile amidst the current macroeconomic backdrop. Now, as for crude oil and gold, prices have surged in reaction to the mounting tensions in the Middle East. Now, for crude oil, higher than expected inventories throughout the past week exerted additional downward pressure on prices, though the imposition of sanctions on Venezuelan supply did play an offset. Now, in the immediate term, the geopolitical situation stays highly fluid as markets await a potential Israelite response and also whether there would be any additional responses from Iran. Now, this means that crude oil and gold prices could stay elevated for a while on a higher embedded geopolitical risk premium. Now, in the longer run, the impact of the geopolitical developments on commodity prices depends on the effect that they have on supply and demand. Now, while gold supply-demand balance is unlikely to be affected, a broader fallout could disrupt oil supplies. Now, we are cognizant that the geopolitical risk premium could be sticky, but the high spare capacity of the OPEC could limit the upside risk to oil prices. So, on balance, we believe it's prudent to maintain core exposures to gold and oil as hedges against the rebound in geopolitical risk. So, we will add on pullback. Now, from the currency perspective, the US dollar could benefit from safe haven demand if geopolitical tensions continue to escalate. The dollar yen has broken a 34-year high. Technically, upward pressures remain. Japan's Ministry of Finance seems keen to prevent the yen from weakening further. We'll likely hear more verbal intervention from them with the risk of an actual intervention. The near term, we expect the dollar yen to test 157, which is the next resistance level. Though 6 to 12 months out, we do expect the pair to moderate to 152 or lower.
Thanks, Raymond, for that broad overview. Quite a number of interesting ideas in there. But I wanted to pick up on your point on international diversification. I know Indian equities is one of the regions you particularly favor at this point in time. What's your view in the context of the upcoming elections? Is that something investors should worry about, or is that business as usual?
Historically, Indian equities have performed well heading into the general elections. The strong rally in India equities since Q4 last year has been in line with this historical trend. As markets appear to factor in the incumbent government retaining the mandate. Now, this justifies the market optimism because a decisive NDA victory would mean policy continuity and suggest scope for further policy reforms related to land and labor. These conditions would support strong investment-related economic growth and corporate profitability, which is likely positive for capital markets. Nonetheless, history does suggest that opinion polls do not take away the risk of surprise polling outcomes, as sentiments can swing before the actual poll. This year's elections would be fought between the incumbent NDA coalition led by the BJP and the India coalition led by the principal opposition party, Indian National Congress. The main opposition party is focused on social welfare, with promises to provide income support to weaker sections, along with legal guarantees for minimal support prices for crops. The BJP builds on policy continuity with a focus on macroeconomic stability, increasing safety net for the vulnerable and unorganized sectors, continued focus on building infrastructure, as well as building India's manufacturing capability. The latest public opinion poll in India indicates that the incumbent NDA is likely to have a comfortable majority. The NDA coalition, led by a weaker BJP, could limit the elected government's capability to push through bold reforms and force a gradual shift towards boosting consumption. While a low probability, this outcome can trigger market volatility in the near term. An India alliance victory would remain a fatal risk and could be an adverse shock to the market, with a likely moderation in capex and increased government spending on consumption that would be inflationary. So overall, we do believe that medium-term prospects of India equities remain very much intact. India's overall macro conditions remain very resilient on strong economic growth, declining inflation, fiscal prudence, improving external accounts, as well as a stable rupee.
Okay, so I think that's clear in terms of Indian equities. What about Chinese equity markets? I mean, do you see any interesting opportunities there in today's context?
Now, to start off, right, investor positioning in China equities is extremely light. Valuation is cheap, and positioning has remained at these steadily low levels over the past few months. If we look at the March economic data prints, they seem largely mixed to me, right? Though some did start to beat low expectations. Now, so overall, downside in China equities appears limited to me, with good support for the Hang Seng Index at around 16,000 levels. Now, we do see one potential pocket of opportunity, which is the non-financial Chinese SOEs that pay high dividends. We think this basket of quality SOEs would give investor exposure to China in a relatively defensive manner. Now, we believe non-financial SOEs in China that pay high dividends would give investors exposure. And also, the Chinese government has added recently market capitalization management to one of the KPIs for the SOE management. So we do think this change will incentivize the SOE management to be more shareholder friendly, including potentially announcing more stock buyback and raising dividends in the upcoming earnings season. The other pocket of opportunity would be the Chinese technology hardware sector. We have seen some recovery in the smartphone market. And also, we think that there's been a pickup in demand stirred by AI-enabled hardware upgrade as well as chips as well. So that's why we think that the procurement demand this year for hardware could pick up at a healthy pace, and which would bode well for the Chinese hardware sector that has seen a pretty big pullback over the past couple of months.
Okay, well, thanks, Raymond. I think we're about out of time, so we'll bring the conversation to an end there. If I can, take the opportunity to just sum up my key takeaways, a lot from today's conversation, but first key message being, of course, that we see the current market pullback as a great opportunity to add further exposure to diversified foundation portfolios. Second, of course, Indian equities remains a preferred area for us, so we would not get excessively concerned about the ongoing elections. And third, of course, Raymond discussed two potential opportunities from a tactical basis in Chinese equities. So thank you, Raymond, for taking the time to join us today. And thank you, listeners, for listening to today's podcast. We hope you found the conversation useful, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.